Well, now to discuss Europe's debt deal, we're joined by economics correspondent Stephen Long. Well, Stephen, welcome. Wobbles on European markets already. Is the gloss coming off this latest debt deal?
And how quickly? A rally yesterday, but stocks are down a little tonight. The US index futures are down too, Ali. And we've seen the Italian government try to auction bonds to fund its debt, and the auction wasn't fully subscribed. They couldn't sell as many bonds as they wanted. Investors were demanding a pretty high premium. The Spanish unemployment rate has gone up to a 15-year high of 21.5%. All of that underlines the seriousness of the economic problems in the eurozone, which are driving this whole thing and is raising doubts about whether this package will work.
And even though the markets cheered earlier in the week, it's fair to say, isn't it, that the devil will be in the detail, and we really haven't got that nitty-gritty, potentially troubling detail yet.
No, for example, the core proposal really is that they're going to create the stability fund, turn it into an insurance scheme so that private investors who buy bonds to fund Europe's debt will be able to purchase insurance from this stability facility. But we don't know at what cost. We don't know what guarantees of losses are going to be provided. We won't know that until sometime in November, because the details are still being worked out. But already it's pretty obvious, I think, that there are a number of unintended consequences that could flow from this. One is that it seems logical that if you're going to insure future government debt in the European Union, then what's going to happen to the existing debt, the people who hold the bonds that are there? You've got a two-tier bond system, one insured against losses, one not. Well, it's going to trash the value of the existing bonds, which raises questions about the banks and the capital that they hold. Problem number one. And then you move on and look at the fact that a whole lot of banks holding Greek debt had taken out insurance in the financial markets through credit default swaps against Greece defaulting. And now they're in the invidious position of being told they have to accept a voluntary 50% haircut on their bond holdings when they'd actually be financially better off calling in the insurance contracts. And so that whole market for insurance contracts has basically been undermined, raising serious issues about finance, sustainability of the market. Plus, the sums clearly aren't enough. It's obvious, and the commentary is starting to flow, that the $1 trillion they're talking about, it's going to be difficult to get it. And if you had a run on Italy or Spain, which was what drove this whole process, those sums just would be not nearly enough.
And that, of course, also raises the question of, with Europe knocking on Beijing's door, even if China does stump up, what they will want in return for stumping up. Stephen Long, many thanks.
You're welcome.